Welcome back to Trader UK. Adam here with a slightly different subject than we're used to covering on the channel today. I want to talk to you about the UK housing market and how likely we are to see a housing market correction or crash in the rest of 2021 or even into 2022. So in today's video, I'm going to cover a July update of the housing market that was recently given by Rightmove. We'll touch on why there's so much speculation about an upcoming crash and how this market in particular may impact your stock portfolio, because that's what we're really interested in. Now, if any of you have found yourselves in the same position that I've been in recently, and you've been trying to buy a property in 2021 or even rent a property for that matter, then you will understand that there has been a problem with the housing market. In fact, do let me know down in the comments if you have found yourself in a similar situation. Properties that do get listed rarely actually make it onto the wider market. They're often sold or let within days, normally to people who have registered their interest directly with the agent prior to the property becoming available. You'll also notice if you go and skim through the property listings that more and more properties are being sold via an auction format, which is normally actually a little bit rarer in the UK. But when you know that any property that you list is going to receive multiple offers within days, then it makes sense to just let buyers fight it out in an auction style format, and often you end up achieving well above market value. So probably the best way for us to really understand what's been going on and how things may play out in the future is to look at the Rightmove 2021 July update. If you're not from the UK, then Rightmove are a popular property search engine. They cover about 90% of all UK estate agent listings, so their data is very complete. Their report states here that it was the busiest ever first half of a year, and that pushes average price of properties coming onto the market to a new record high for the fourth consecutive month and £21,389 higher than 6 months ago. Now, later in the article, they dive into those numbers a little bit more, and they go on to say, Rightmove expects that the number of sales completed in the first 6 months of the year, and due to be reported by HMRC later this week, is on course to be around 800,000, which could just beat the previous record of 795,000 set in 2007. The 2007 record was set under very different circumstances at a time when mortgage lending criteria were much less stringent than in today's more controlled market. This is actually an important point to make, because your immediate reaction to that is that by beating records set in 2007, it almost signals that we're following the same pattern that led to the 2008 recession and credit crunch and subsequent property market crash. But like they said, the lending criteria are very different now, and banks and lenders are kept a close eye on to ensure that they always have sufficient liquidity. Now, I think most people who watch this channel are actually around my age, so you should remember 2008 pretty well. But for any younger viewers out there who maybe don't understand exactly what happened, it wasn't always this difficult to borrow money to buy your property. In fact, in the build up to 2008, it was a little bit too easy to borrow money. You were able to self-certify mortgages, which basically meant asking the bank if you can borrow £200,000. They would ask you if you could afford to make the repayments, and of course you would say, yes, I can. Providing you didn't have a horrible credit history, then that mortgage would normally get approved. On top of that, minimum deposit requirements were, wait for it, 0%. So if you could afford to pay the solicitor fee, then you could afford to buy a property by taking a 100% loan to value mortgage. But wait, it gets worse. Let's say you wanted to buy a fixer-upper, but you don't have a deposit and you don't have any money to do the work that is needed. Well, that wasn't really a problem either. Just take a 125% mortgage, meaning you'll be able to buy your house and then you'll have 25% of its value in cash to play with. Of course, looking back now, we understand that was the cause of the 2008 crash and the subsequent recession. But at the time, unless you were Michael Burry, who famously shorted the housing market, then you probably actually didn't see it coming. But like Rightmove stated, the lending market is actually very different now. So bad lending is actually very unlikely to cause a crash, as people in general can actually afford the repayments on what they're borrowing for now. It goes on to say, with the first half of 2021 seeing 140,000 more sales being agreed and 85,000 fewer new listings than the long-term average, this surge in activity has revealed a shortfall of 225,000 properties, 225,000 homes for sale, which, if available, would have corrected this stark imbalance between supply and demand and would have stabilized price growth. It then goes on just to detail a little bit the main impact was on the upper end of the market, and first-time buyers were less impacted by these price rises. Price rises across the board, but more so for higher-end properties. So like any asset price, the key driver is always going to be supply and demand. And in the current market, it's a double-ended sword. We have more buyers than usual, and we also have less sellers than usual. I think that rather than trying to justify why that's happened, like the stamp duty holiday, or maybe the changing working from home behavior caused by the pandemic, at this stage, it's probably more important to just highlight how big that shortfall actually is. 225,000 is a shortfall. Later in the article, it states that the average estate agent has only 16 properties on their books compared to the average for this time of year of 31. So it's roughly half in terms of inventories. That is a big deficit. And remember, in order to see like a market correction or a market crash, first of all, we need the inventories to recover to normal levels, which alone requires 225,000 more sellers than buyers. Long story short, even in the perfect conditions, it's going to take a long time to replenish those inventory levels. The final point from Rightmove is that with the ongoing need for housing, high activity levels despite the June stamp duty deadline now passing, and with residential property prices appreciating better than many other asset classes, we expect positive sentiment to continue. So they're talking from a July perspective here. Clearly demand is still high despite the end of the stamp duty holiday, which many people thought would actually crash the market. And they also believe that because the stock market and other assets have been pretty flat in 2021 and the housing market has really outperformed, the housing market will continue to look attractive to investors. Remember that there is more money in circulation now than ever before, and no matter how it's distributed, it always finds its way to the richer individuals who ultimately end up investing it. And right now, I would say that the property market still looks like a good place to be. So Rightmove, in all their wisdom, clearly don't see any property crash on the horizon, and neither do most agents. This article from Butters John B predicts more modest annual gains moving forward of 4, 3.5 and then 3% over the next few years. But again, that certainly doesn't suggest we're heading towards a crash or a correction anytime soon. So why is it that so many people are holding their breath and waiting for those prices to pull back? Well, I think it comes down to one of two things. Firstly, it could be blind optimism. I say optimism because these are actually investors who are looking to buy property and are hopeful of a pullback before they invest their money. And secondly, I think people are looking for too many similarities between this property market and the 2007-2008 market. And although there are plenty of numbers and data points that do look similar, such as record property sales in the first half of the year, such as the biggest year-on-year increase since 2007, there are also some big differences between how the lending market that supports the housing market is set up right now. And we've touched on that already in the video. So overall, I know it's an easy answer to give, but I have to agree with the experts. I can't see any substantial pullback in the property market. I think the lending market is still far too stable for that. I think demand is still too strong. And although that demand is likely to drop following the end of the stamp duty holiday, so is supply. So we find ourselves in exactly the same position in terms of the imbalance that we've seen, which is probably going to take 12 months or so to correct itself. So what about how this property market might impact the stock market in the nearer term? The only real headwind that I can see for the housing market is a potential rate rise. That's already been signalled for next year by the Bank of England in order to tackle inflation, which means it's the same catalyst that we're watching out for as we are in the stock market. The big difference is that in the stock market, we're forward looking and the rate rises are already being baked into the valuations somewhat. But considering the fact that homeowners have accumulated substantial gains on their properties over the past couple of years, combined with the fact that borrowing is soon to get more expensive, we could see a wave of refinancing over the next 12 months to lock in those low rates. This would be very good news for the stock market, as it means consumers would benefit from a boost in disposable income. Essentially, it means that although multiples would get squeezed by the rising rates, earnings figures may get an unexpected boost from an influx of people securing cheap debt against their properties. In summary, I would say the state of the housing market should reflect very well on the stock market. The growth rate is slowing down, so it's going to provide less competition for investors who always look for the biggest returns possible. Plus, a bumper year and rising rates should force a wave of cheap debt into the pockets of consumers. That's going to be all for today. As always, thank you very much for watching. Let me know your thoughts down in the comments and I'll see you next time.